Ram says, what are some good strategies, methods, handle hedge, long positions in stocks like NVIDIA with high volatility? Well, I joked earlier when we first read this discussion, you said you probably know what my answer is going to be. And the best hedge that you can do for a position, especially a position that you have an unrealized profit in, even if it's volatile, is going to be a married put position. It's the best one-to-one protection to keep your losses single digits or to lock in your gains on an underlying position, Ram, and still be able to do other income methods and adjustments to the upside with the income methods that we talk about in our full course, the blueprint, the proper married put structure, and the 12 different income methods we use off of that structure. So I'm assuming, Ram, that you mean long stock position only, not long option positions. Buying a call, bull call debit spread, and something else. All right. So now you said, I'm sorry, my apologies. Little frog in the throat there. You had mentioned that long positions, of course, and you just clarified that for me. But we're talking about NVIDIA. Okay. So right now, let's just take a look. Where is NVIDIA and we know where NVIDIA's been, but where is NVIDIA now? I think it's at 125, 126.57 is where it closed today. All right. So we're at 126.57. By comparison, Ram, this is not really that volatile, to tell you the truth. The movement in NVIDIA, even when it was up at those higher prices, you're saying, oh God, it's moving $60 a day. It was at $1,100. That's not a very, very volatile movement. It's a lot of money. It's a lot of money per share. Do not get me wrong. But this is mid-range right now for volatility. I think the average volatility, 20-day or 50-day volatility across the market is around 0.65 or 0.7. So this is up near the higher end, but it's nowhere near what I'd consider volatile. Right now, Oscar Health is something that you might consider volatile. Biotech stocks. This is going to be fairly priced. Our preferred structure in the married put, following the course in the blueprint, is we're going to buy a stock. We're going to buy a put option that's in the money. It's above the current stock price, and at least 150, 180, maybe even 300 days out in time. The idea being that gets us the best opportunity for single-digit risk on the position. Then we're going to use those income methods and adjustments, Ram, to start lowering the cost basis. So some examples, let's just go to our search. Our preferred search here, 95% of the married puts that Ernie and I open and post in the Fusion portfolio at Radioactive Trading come right from this list. In fact, I think right now I see 4 of them that are posted in our portfolios. They're on this list, but Ernie and I have been in for a while. MMYT, I think that stock's up 25, 26% since I got into it. PSTG, this one I got in at 59. It was as high as 70, and it's pulled back a little bit. A lot of things pulled back. Ernie's in BROS. He is also in KTOS. And if I'm not mistaken, he's also in PINS. Or maybe it's Pan and American Silver I'm thinking of. In any case, what's the structure? Okay, well, let's just take PSTG here. As I mentioned, it's 64.48, right around 65. I could buy a December 70 strike put. It's 182 days out in time. Now, it's going to cost me about 1025, 1030, 1040 around midpoint. So we're going to have a net debit of 75.18, but I'm guaranteed no matter what happens next, at any time between now and December expiration, I can get at least bare minimum $70 back on this position. So my total risk guaranteed is only 518 or 6.9% of what I invested into the position. Okay, with the midpoint, it dropped down to 6.3%. So the put gives me the right. I paid for that right to force someone to buy my shares of stock at 70. PSTG could be cut in half. It could drop to $35 per share. I still can force someone to buy my shares of stock at 70. Or I can just sell to close the put, get some time value, and sell to close my stock, and I'll have less than the 6.3% return. Okay, and naturally say, oh, well, you went ahead and did this. You bought the 70 put. You could probably sell the 70 call right now. Let's just go 28 days out in time. Get a little premium, about 90 cents. And that's going to reduce your risk. And that's right. That's income method number 1, selling a call. But it also caps the gain, gives me an upper and lower break even because I want to wait for the stock to move up to get closer to 70 to maximize the premium I'm getting for that 70 strike, or 72.5 if it's available, and continue. But I've already lowered the risk from 6.3 down to 4.6 to the downside. It is one-to-one protection. Okay, the put, 100 shares in one put, 200 shares in two puts. It's one-to-one protection, Ram. That's what I'm looking for. Now, the case like NVIDIA, is it, let's say I'm in December, I'm sorry, and it's about one strike above the current stock price. And that was a 6.3, 6.4% risk on pure storage. Now, we could look it up, but we're not going to do that. We're just going to see what NVIDIA would look like right now. Let's go ahead and add stock today at 100 shares. I'm going to try to keep almost the same strike price, Ram. You know, we were looking at a $64, $65 stock and buying the 70 strike. So with NVIDIA, we saw at 126. I do have December. Perfect. 182 days out. And sorry for the scrolling. I'm probably going to be looking for that 130 strike. But I might go higher to one. There's not even a 135. That's odd. Let's just try the 130 strike first. Yes, it's expensive. It's going to be $2,000 at least to buy this put. But remember, insurance in all cases comes down to you get what you pay for. Now, I'm going to illustrate that in just a moment to you too, Ram, and then we're going to talk about other ideas and concepts. It's buying the 130 call here. Stock's at 126.57. You know, as I mentioned, about $2,000, $20 per contract to buy the 130. I put call. Brilliant, Mike. You can tell it's Friday, ladies and gentlemen. Let's try that again correctly with the 130 put this time. And let me just pause the screen here so you guys don't have to watch the scrolling from $20 per share up to 130. All right, fantastic. All right, so this is about similar price though. But remember, the 130 put is at 17. It's going to be around 1880 or so, $1,880. But $4 of that, $3.50 is intrinsic value. I'm guaranteed to get that back. So the time value cost here is only going to be about 15. And the time value cost in this setup, Ram, that's what ends up becoming your true at risk. So let's get down there. And just going to buy one contract. Unpause the screen. There we go. And we're just going to take the midpoint price of that put. Fantastic. Okay, so I'm a little bit closer to the money, right? 4 points, 3.5 points out of the money on a $126 stock is about half the range in the money, I should say, my apologies, that we were looking at with the 64.48 pure storage with the 70 strike. I probably want to go to the 135 to get the better risk. But in any case, this here, still closer than I should be. I'd want to go deeper in the money. I can already tell. I probably want to be about 8 to 10% in the money, most likely. So that would, put me about 12 points in the money. So I'd be up at, 138, almost 140, I think would be the better strike. And you'd see a risk at about 5.5, 6.5%, same as we saw in pure storage with the same range in the money. This is too close to at the money. That's why it's increased above 10%. But in any case, what is this saying to me now? Unlimited upside. Yeah, I paid for the put, but I've got unlimited upside profit potential in this position right now. And even if the stock fell 30%, I can't lose more than 10%. Guaranteed. It's locked in. That's the benefit of purchasing the put option. Am I adding cost? A little bit over 10% of the underlying cost to get into this position, maybe 15%. Yes, I am. But remember, some of that I'm guaranteed to get back. So the true risk is only 1532. Now, concepts of this, a volatile security. And let's just do 140 because it's probably the one I would have chosen. But we're going to look at something else in just a minute. One of my favorite things to do here, Ram. And we do it often around earnings season. You're not seeing this right now, but I'm doing the same thing, ladies and gentlemen. I'm going to the December 140 put now. Deeper in the money, probably more in the correct space I want. It's going to be about 24.20 at midpoint. I'm just saving you the scrolling through this intense chain that we have for NVIDIA. There we go. Okay, so we're buying now. Our 140 strike put for December, 7.2% at risk. Now, a lot of times during the year, especially when we go to that end of year promo discussion for the full course, the blueprint that discusses the initial setup that we're looking at here, full application, correct application of the 12 different income methods. We talk about something around earnings. And a lot of people ask, And it's similar to Ram's question. Hey, I've got this stock that I've been holding for a while, earnings coming up. What is the best way to hedge it? And what I typically do is, let's say here, we know we had the split recently. You might have had a higher price on NVIDIA or a lower cost basis on NVIDIA for a while ago. But here under the Married Put tab, we do have the insurance tool. Now, I bring this up because I had a gentleman who was a Ameriprise financial advisor, a member of Power Options, and he called me today. And he has a customer that has sort of a married put collar structure, long-term put, short-term call against it on Apple. I think his cost basis is $26 per share. So we use this tool for that one, but we're going to use it for the same here in NVIDIA. And let's say that my cost basis is actually $110 after the split, after income, after holding the stock for a period of time, going through all of that of the last year. And I say, I want to hold this position long term. So I want to go out to December, 182 days, as Mike showed me. Now, what this tool is going to do, it's going to take this look and it's going to say, okay, well, you've got 15% of unrealized profit in your position. And right now, going out to December, we can see some of these put options that are available that are going to be able to lock me into a guaranteed profit. Now, it's not as much as I'd hoped, and this might be due to a little bit of the volatility Ram had mentioned. But right here, we're seeing something here where I could buy that December 130. Now, remember, this isn't the one I'd likely buy now. We already saw that the 130 wasn't enough. 132 might have been close, but yeah, I would prefer to be at that 140, 142 level with that 6.5% risk, only single-digit risk on the position. And on NVIDIA here, here's an option. If I did have this cost basis, I could buy the 132 put now. Again, $13 of time value, but the total cost is going to be around $19.38 at midpoint. Because I have some intrinsic value for the stock, we have about $5.50 of intrinsic value, but the $13.94 is the time premium. Cost basis at 110, roughly $19.38 for the put. So my total cost of the position is $129.38, but I'm guaranteed to get $132 back. Locked in profit is 2%. What does that mean? It means it's a bulletproof position. I've now set myself up for the next 180 days to where I'm guaranteed to make a profit of 2%, even if NVIDIA falls another 10, 15, or 20%. I've left the upside open as well, so I can still take advantage of further upside movement. The 2% profit is the absolute worst case scenario. Making 2% profit on this position is the absolute worst case scenario if I did this with my lowered cost basis, held the position all the way to December expiration, accepted no dividends, sold no calls, or did no other income methods and no other adjustments to the put. I could disappear and go, on a 6-month tour of the world, come back, and I'm either going to have a higher profit on the video or guaranteed 2% return. It sounds like I'm giving up a lot, right? Because I could get out right now for 15. But I'm doing this because I'm projecting further upside. I just want to handle what? Market volatility and the unexpected. So what did I just say? I did this because I'm still bullish on the video. I'm locking in some profit. I'd like to see a little bit more locked in profit. Okay, but that's, as we said, as Ram said, it's a little bit more volatile. So it's a little bit of price. It's a high time value price there. But can I increase my position at this point? Even more, Ram? Absolutely. And as we know, we talked before a moment ago, and we're going to talk a little bit about collars in a few minutes, dynamic collars that we're looking at now. But now, shorter term, I could say, you know what, I don't have earnings coming up. I don't know when the video's earnings are, but I could say, hey, I don't have earnings coming up, so let's just go standard July expiration. I bought that 140 put out there. Hold on one second, folks. And, I've got a 2% guaranteed profit, but I want to get a little bit more. I still want to reward myself for picking the right stock, being in this good position. So why don't I go ahead now? I want to give myself a little bit of breathing room, but let's go ahead and sell that July 135 call, get a midpoint of maybe about 445 or so. Okay? So let's go ahead and add that in. I've got my locked in protection with the put from the insurance tool with my cost basis. I'm going to reward myself now by selling some premium, getting about $4 more on this position, 440 or so, 447 more on this position. Now my guaranteed profit is 5.7%. Negative max risk is the guaranteed locked in profit of 5.7%. And yeah, I might not be expecting NVIDIA to get up to 135 in the next 30 days, but we know NVIDIA, it absolutely could. The AI market, anytime news comes out, we could see that. Any one of the competitors that are in there that are also doing well is still going to lift NVIDIA. If AMD starts doing better, one of the other ones, it's going to start pulling them all up together. It has the whole time. So what did I do? I added a put far out in time because I wanted to get more upside profit, but I'm worried about the market as a whole, maybe not necessarily this particular stock. I rewarded myself by getting premium, but at the same time, I capped my upside because I know this is a volatile stock. It could explode more. I don't want to give up profit if it jumps up to 150 and I'm holding the 135 call. So what I can do now is take half of this, maybe a little bit less. We're going to stay in that July series, July 19th. And I just sold our 135 call, but I'm going to give myself, I'm going to give myself a little bit more, meaning that I'm going to go to this 145 call now, which is going to be around $2, maybe a little bit more, but it's going to be about half the price of what I got for the 135. So I'm taking half of the profit that I might have generated by selling this 135 call. I'm buying a higher strike call for about half the premium that I collected. Why am I doing this? Well, it's what I like to call the hat trick for locking in gains. Because now what I've accomplished is I protected my underlying security, have the locked in profit. Sold a call to reward myself, but I would always want the call to be above the put strike price, but that capped my upside. Taking half of that reward to buy a call, why? Because now, again, I've left the upside infinitely open. A little bump here, but if the stock exceeds my expectations and NVIDIA has one of those runs, I'm still guaranteed a 4% profit right now. But if it has one of those strong runs, even if I get assigned here on NVIDIA at 135, my long call is still gaining in value. I can use that to get back into the stock position. So why do I call it the hat trick for locking in gains? Number one, we locked in gains with the put. Number two, and we're longer term, we want to hold for more upside. That's why we're buying the put. Number two, we rewarded ourselves by generating income by selling that call, but it did cap the upside. And now number three, we left the upside open by buying that extra call. So 1, 2, 3 solves all the problems. I've locked in gains and I left the upside open while still generating income and increasing my guaranteed bulletproof status. The hat trick for locking in gains. By the way, that is income method number 6 in the blueprint. But when we have these positions where you're heading into earnings with unrealized gains on your stock, you want to what? You want to lock in the unrealized gains going into earnings in case there's a poor earnings event. You did pick the right stocks. You want a little reward for that for you, but it might have a surprise to the other side. So I want to make sure that I leave the upside open, and this solves that. This solves all three of those dilemmas. So it's locking in the put in that question and doing it that way, okay? And then, Ram says, my question was in the last 2 days, NVIDIA fell from 141 to 127. Should I have bought the deep ITM puts at 50? If you did this when it was at 141 Ram, and you bought the 150 put, it would have given you some locked in profit. I can guarantee that. It might have had that higher time value. It might not have been as deep in the money, but yeah, 150, 155 would have been the strike. And now the stock, of course, as you mentioned, is down to 127. Excellent. Okay, so the stock's down to 127. Sorry, I'm not on the right tool there. There we go. And it's okay because your put that you're holding, the 150 or 155, and the stock's at 141, would have a 10, 12 point gain in it, maybe more. Okay. And let me just go. I should have just gone there from the page I was on. It's poor move on my part. Sorry. But let's just take a look at the chart here. Yeah. So it's just the last few days. So yeah, just the other day, if you got it, at the open, I don't have the date on that. We only have the closed data. But if you had bought the 150 or 155, you probably still would have locked in, even from December, that 2.5%, 3% and being bulletproof. Now that the stock's trading here, you could say to yourself, okay, I've got a gain on a put. Following the blueprint, I could use income method number 9, take the profit on the put and reestablish the position. Essentially, you're getting paid at that point to average down the position. Instead of putting more money into the stock to try to get a better cost basis, if I just bought at 141 and the stock fell to 127, one day later, what's your immediate thought? Oh, I still have a winner, but I can average down. Let me buy another 50 shares and there's 75 shares at this lower price. So I can get a lower cost basis. So when the recovery happens, I can make more profit. Once you already have the put in place and the stock falls, you're taking the profit off the put to reestablish the position. You're lowering your cost basis. You're averaging down, but getting paid to average down, Ram. So it still would work the same way. But what we tend to look for more often than not is we want to see sort of a pattern like this, with the MACD crossover, stock having now a positive MACD crossover after a bottom, going back above the SMA 20. You're not below the SMA 20 yet, so you're seeing some pullbacks, but this is a pretty significant pullback. But right now, it looks like the MACD is still crossing negative. It'll be interesting to see what happens on Monday and what news comes out over the weekend, Ram. But, when I typically do that move with the put, sell to close the put that I have, buy to close the lower, or buy to open the lower strike put, it may increase my percentage at risk, but I'm lowering my cost basis to get better benefit. So I want to be in this area here when I see that in order to do that, because I don't want it to keep going down. I don't want to keep following it down. So what do I mean by following it down? Well, as you mentioned, if yesterday I would have bought the 150 and then today it had this drop to 127, I don't immediately want to drop down to the 140, 135. I can wait it out. That's a great other thing about the married put. I can just wait it out, Ram. I don't have to, as you know, you said you've got the blueprint there, so you know. And sometimes it's, you can call it inaction. But look, if it jumps back up to 142 tomorrow, what was the point of rolling down the put today just to roll it back up on Monday? So I've got time to wait to see what the stock does. My protection's out to December in the examples that we showed. I'm in no immediate rush to jump on every little daily trend. I might be doing that with the short-term income, selling weekly calls against it, doing things like that in the nested structure of controlled risk. But I'm not panicking every day that there's a movement. And a lot of the Blueprint owners and Fusion subscribers, if they're following one of my positions on the Fusion subscription at Radioactive Trading, say, hey, Mike, an example is Fortinet had earnings the other day, and 2 days later, it dropped 7%. What are you going to do? Nothing. It puts out to November. I want to see how the market settles and how the market plays out. Not only my stock, but what's going on in the market in general. I've got time to wait a day or two, knowing I only have a risk of, actually, Fortinet's a bulletproof position. So it's a guaranteed profit of 2%. I am under no pressure to chase the market every time there's a drop in the morning or rise more. Now, that's for the married put positions. Other positions in my portfolio, yeah, I have to pay attention to that, Ram. Those other positions that represent, 10, 12, 15% of my portfolio, credit spreads, things of that nature. They're much more mobile, much more volatile, and I have to pay more attention to them. But even with a 10, 15% drop after earnings, I can take a step back. I don't have to react right away. The difference between the put prices that I had that immediate day when it dropped and 4 days later, if it's still trading in that range, are going to be very close to the same. Or even if it's a little bit lower, the percentage and combinations I can get are going to be very close to the same. So, yes, 141 the other day. I could just look at it at close when it was at 130. It was pretty much where it is now. So that does now. Maybe at 135 here. Let's go back to that date. Chain. It's going to go to the chain. And we've got NVDA, and I just want puts. I want 2 days ago, which would be the 19th, Juneteenth, actually. Oh, the market was closed. Let's go to the 18th, see where we were. So it's going to take a minute here. I'm going to clean up some of these tabs while it's doing that, Ram, but it's going to take a minute here. It's interacting. There you go. So it's at 135. It's not too bad, right? We want the December puts. And yeah, so the 150, it's not even shown here, but let's go. I can go to medium chain. So yeah, we want to see the 150. Here we go. Would have been at 2610 when the stock was at 136. Did we say 135? But the time value here is at 11%. I'm sorry. Yeah, let's just build it real quick. We can do that. Let's go to custom spreads. And I'm sorry, my stock price was at 135.58. So I know your price is different, but again, you could do that in the insurance tool. But yesterday, let's keep our cost basis of 110 RAM. Why don't we do that? But we would have bought the 150 December. Let's see here. Now the current cost basis of that 150 put is, that's market close. The exchanges went weird. It's got a 9-point bid-ask spread between 28 and 37. I think it's going to be fairly priced right now at probably halfway point there. So probably around 32.50, 33.50 right now. And I know you're not seeing what I'm doing because I'm saving you guys from the scrolling, but it was 26.10 the other day when the stock was at 135. Okay. So let's go ahead and show that. Remember, we're keeping a cost basis of 110. And we're adding the 150 put for the midpoint price 2 days ago at 26.10 when the stock was around that 135 range. Bulletproof status of 10.2%. And where's our put right now? Let's just go ahead and add it to the portfolio. And we'll just call it Married Put Talk. And that's an older one. We'll just add it to the Married Put Talk portfolio very quickly. Okay. There we go. All right. So now we're here. We just have these two. This one was a married put that I was in actually on the stock on AMD. I traded that, opened it in March of 2023. Worked out well for me, by the way. But the NVDA position here, see the put's gone up 640 total, and the stock's up 1657. But remember, it's not. It's down 9 points roughly from that 135. We've only gained, we've gained 640 there. That's the actual. I'm sorry. So right now you have a profit. The current price today was 250. See, it's moving half as we'd expect. Okay, so the stock fell 421 today. The put moved up 250. We've got a $640 gain in the put position. And if we liquidated everything right now, we'd still have a 17% profit. Or I can take this total $640 profit off of the put, move it down in price, reposition it if I feel I'm at the bottom. Because I don't necessarily, like what I said, I don't want to chase it now. I want to leave the 150 put open. If it falls to, not trying to scare you, Ram, but if it falls to 121, 119, 118, I'm just going to be getting closer to one-to-one protection as this delta gets closer to 1 as it goes deeper in the money. Then when I say I found the bottom, I'm going to cash this out and move down to a lower put and continue to trade as a new married put with a lower cost basis on my position by taking the profit of the put off the table. But of course, you know that because that's all in the blueprint. That was income method number 9, or of course you combine 9 with 3 or other income methods there to continue on with that structure as well. Now, keeping with our 110 cost basis, comments come in as comments do. And we've had some of these discussions before. And you're saying, okay, well, you're paying $2,600 right now, which is almost 20% of what this, where the stock was or where the stock is right now. We're basing it on a lower cost basis, but true. Paying $2,610, that's almost 20% here of the current cost base of the stock. Well, this is 2 days ago, but still, I get it. Why pay so much for the put? Can't you do better and pay for some of that put by doing, say, a bear put debit spread? You buy your 150 put here, but then what if you sold a lower strike 145, which would create what's called a bear put debit spread? So now I might be only paying $13 or $14 for this position. Remember, this is the profit and loss chart of a long put. It has infinite downside potential to 0, unchecked. That's the best one-to-one direct hedge against a stock holding. It is expensive, but remember, you get what you pay for. I want to talk about that in 1 second too. We're not going to take too long on that. I want to jot this down. So why not cheapen this price here and create a spread? Well, again, let's go back to our option chain from NVIDIA from that same day. And I said the 145 would be at 22.98 at midpoint. All right. So let's go ahead and sell that 145 at 22.98. That was July 19th, right? No, I'm in December. I apologize, folks. I'm in December. There we go. 182 days out. So we're doing a bear put debit spread. We paid for the higher priced insurance at that 2610 or whatever we did. That was from 2 days ago when the stock was at 136. And we're going to get our 2298 back in premium by selling the 145 put. That's our bear put debit spread. Now, the problem with this structure is, am I going to get a much lower cost of insurance? Because I paid 2610 for it. I'm getting 2298 back, is what we said. I might as well just call it 23, but we're going to keep it at 2298 at the midpoint. And so I'm only paying, less than $4 for this position, for this insurance. But I'm not insured any further below 145. The purchase price of this put can only protect what? It can only protect the 100 shares of stock or this sold put. And as you can see here, we're still in a profit zone because we're using that cost basis of 110 and we had the bulletproof status. But now in this case, we're getting closer and closer to our break even. Well, not too close really, but we're getting closer to that value. We're losing more profit. We didn't keep the locked in profit that we had because now we're either losing on the short put or that. So we're not covering it. Then the sample is, well, why not just do a ratio spread? Okay, so now you would have bought 2 puts. I know this is getting confusing, but bear with me. And buy 2 puts here at this price, but really what you're doing is insuring the stock and then protecting and then adding a bear put debit spread for a little bit more oomph where the stock falls in price. So I'm buying 2. I'm going to have a $5,200 cost and I'm getting $23 back. Now I just added a debit of $29 for the same protection I almost would have had I just bought the put itself. In fact, it's only 7.7%. And you get this neat little check mark thing. This is complicated. I understand it. But again, it's down here. If it's below 145, which where it is, it creeps back up to that 10% we were looking at with just the put itself. That low range of 7.7% is here before you get the extra benefit of the $2 back from the bear put debit spread. Why not just buy the put outright? And the reason I say that is because it's complicated. Why complicate it? You didn't really lower your cost, right? I paid $26.10 for the put. If I bought 2 puts, it'd be $52.20, and then I got 23 back for it. So now I increased my cost by $2,900, only to get an extra $250 back from that 5-point spread. Yeah, and no, it's overcomplicating what's unnecessary. Yeah, that little bump up to $1,600, but here's the other problem I have with that. And that other spread was saying, oh, if the stock was below, I know it was below 145, it was trading there at that time. But why did I do this to begin with? Because I wanted to lock in some of the unrealized profit I had. I'm still bullish on the position, which is why I'm leaving the upside open. I'm not projecting that it was going to fall from 140 down to 127 or might fall down to 120 or 118 on Monday. I'm not trying to scare you again, Ram. But so I'm following my expectations and keeping it simple. Adding all these other, make it a spread, make it a ratio spread, do this, do a 2 to 1, buy 3 puts and sell 2. So you've got 1 to 1 put protection, and then you've got 2 contracts, or ladder the spread positions. I didn't think it was going to fall this way anyway. That's against my expectations, trying to set up an elaborate spread to enhance my gains to the downside. Because that's not where I thought it was going. I know it could, and it did. But you see what I'm saying? You want to follow your expectations and keep it simple. And that's what the blueprint spells out. It's phrased very simply and very easily to follow the correct paths without getting too confused into different. Now, there are some more elaborate income methods, don't get me wrong. But you don't need to focus on a lot of the things of different Greeks and things like that you would need to focus on doing those structures or spread structures or multi-leg structures by themselves when they're nested into the married put structure, the protected single-digit risk structure. Why is single-digit risk so... Oh, that's where I wanted to go. I'm sorry. Real quick. Just using the current price, we're going to use NVDA again. We're just going to go search by symbol under married put. We're going to use NVDA. And I'm going to go to more results. And why is it not giving me a put expert? There we go. Okay, sorry about that, folks. We're going to go to December. I might see all results, but... Okay, so right now... Yeah, let's go to all. It'll be a better illustration of this, okay? All right, so these are way off base. Now, all right, I'm just gonna have to keep this. I might use a different example. We're gonna have to keep this at more. Okay, sorry about that, folks. Anyway, so the idea is that why are you buying such a pricey insurance? And we were looking at the 140, but originally we looked at the 130 for December. Remember, then we moved it up to the 140 and the 135 too. I think we took a look at, but we were taking this risk of 11% and so forth. And someone says, well, why wouldn't you just buy a 105 or a 110? And like I said, you get what you pay for. Let's just go to the profit and loss chart of our 130 real quick. And we're going to change it as we did before. So remember that we looked at this as that 10.5% risk, 1532 with the time premium. I'm paying 1875 for the put, $1,875, a little bit more than 11%, 12% on that position. Now, why wouldn't I buy some? Let's buy something half of that. Let's find a $9 put for December. Okay. What put option would be priced at $9, half the 1870? And we weren't even going to use the 130. We were going to use the 140, which is even more expensive. But let's find something that's $9, half the price. And it looks, bid-ask spreads are so weird with these out of the monies this far out in time. I apologize. But yeah, let's say this one's going to be 11. So this one's probably going to be closer. This one's right at 1130. So we're going to go with, let's just go with the 110. 845 to 10, probably around $9, somewhere in that bid-ask spread range, okay? So we're going to pay half the price that we would for the 130 put, which gave us a 10.5% risk on the position, paying half the price. For that lower strike 110, and this is based on the current price. I know in the other examples we were using the lower strike 110. So I only paid half the price, but I almost doubled the risk. It's up to 19%. Why? Because you get what you pay for. You only paid $9 for this put, that's true, but the insurance doesn't kick in until the stock reaches 110. You don't start getting any real benefit of that insurance until the stock drops to near the 110 range. So you lose another $16 on the security. Yeah, this is going to move up. As if it drops down to 120, you'll see this go up to $11 or $12. And if it drops down to 115, this will probably go up to $12 or $13, somewhere in that range. But until it drops to 110, your delta is not going above that 0.5 range. You're risking, especially at expiration when all time value is gone, the $16 difference you have plus the $923, which is the $25.80 at risk. Almost double using the in the money put, which is more at the money with the 130. You get what you pay for. Okay, the cheaper insurance is not the best protection, even though it's the lower cost, because the insurance doesn't kick in. That's why we use the in the money put. It's part of the core principles we follow, the radioactive trading techniques, at the money bell curve, radioactive decay line. Why are we buying so far out? Why are we buying slightly in the money? And it's because it offers the best protection. That's described there too.